We begin with breaking news. China has just raised its tariffs against the US from 84% to 125% starting on Saturday. Beijing says it will ignore any further tariff hikes from Washington.
Tariff on US goods now to 125%. It says it no longer will match US tariff increases because at this point, American imports aren't marketable at these levels.
U.S. stocks are tumbling for the second day. The Dow is already down 1,000 points after dropping almost 1,700 points yesterday.
Trump's tariffs could unleash chaos across global markets. Markets are not buying his latest moves. That explosive headline has roiled investors since early April 2025, when the White House announced yet another 90-day hold on additional duties. Instead of soothing concerns, the move spiked volatility. Rumors swirled that panicked advisors had forced the president's hand following a bond market scare. Now, bond yields fluctuate daily, and analysts warn that this seesaw of tariff threats and last-minute reprieves could signal a desperate U.S. administration grasping at straws. Spain's Prime Minister, fresh from an April 10, 2025 visit to Beijing, spoke bluntly about America's fading credibility. As Washington wages a tariff war against nearly everyone, some European leaders see an opening for new partnerships, especially with China. Stick around because these shaky alliances and last-ditch strategies might just change the balance of power across the globe. At its core, this is a conflict over global economic supremacy. The Trump administration, and yes, he remains a towering figure even years into these relentless trade battles, delayed certain tariffs on Chinese consumer goods by 90 days. White House officials framed it as part of a masterful plan, claiming it would corner Beijing into making critical concessions. Yet the markets sniffed out fear rather than strategy. The brief market rally when the news broke evaporated by the next trading session, leaving the Dow down double digits over the past month. Beneath the surface, the tension runs deeper. Washington's official line says the partial rollback was always in the cards. Bond traders, however, point to chaos behind the scenes. The yield on 10-year treasuries soared dangerously, nearly hitting an alarming threshold that could trigger a sell-off. Some claim the White House was forced into retreat by a looming bond market meltdown. A meltdown linked directly to unsustainable tariff levels now at 22.5%, the highest since 1907. In Europe, discontent stirs. Spain, saddled with a massive trade deficit with China, now urges fellow European Union members to pivot eastward. Ever since the White House hammered allies with steel and aluminum duties, confidence in American leadership began to fracture. The Spanish Prime Minister warns, every country loses in a trade war, especially workers and the middle class.
And more tariffs, negative messages to citizens and firms. We need to keep on a positive message to our citizens, telling them that we will help them, that we will support them in these, under these days of tariff or trade conflict.
Yet, U.S. Treasury Secretary Besson upholds the hardline approach. He insists that choking China's production is essential, even as global supply chains creak under the weight of these escalating tariffs.
In terms of escalation, unfortunately, the biggest offender in the global trading system is China, and they're the only country who's escalated.
Does this partial delay betray Trump's real vulnerability? Is the economic giant truly desperate enough to gamble on sanctions, capital restrictions, and bond market brinksmanship? The conflict at hand threatens the foundation of U.S. power and opens the possibility of a world no longer anchored by the dollar. President Trump continues to wield threats of punitive tariffs like a sledgehammer, pausing them only when financial or political blowback becomes too fierce. His approach has baffled many in Washington, who insist these measures will revive U.S.-based production and force China to yield. Yet critics argue the White House is flailing, pointing to contradictory tweets from back in May of 2018 about massive agricultural purchases by China that never truly materialized. This administration's pattern of escalating threats, followed by partial retreats, suggests policy driven by market panic rather than coherent strategy. Treasury Secretary Besson, the administration's loudest hawk, stands by the tough stance. He publicly claims America goaded China into a bad position, forcing Beijing to rely on midnight negotiations.
China is the most imbalanced economy in the history of the modern world, and they are the biggest source of the U.S. trade problem.
In one heated press conference, he declared, "They just keep producing and dumping, and it is going somewhere." Meanwhile, behind closed doors, his department scrambles to steady bond yields and reassure foreign creditors. The newly floated blacklist of Chinese companies, designed to choke off U.S. pension and endowment investments, underscores Washington's willingness to weaponize capital markets. On the other side, Beijing is no passive target. Armed with $750 billion in U.S. treasuries, China can threaten a financial nuclear option by dumping American debt. So far, it has selectively reduced dollar purchases, nudging the greenback downward. While official statements from Chinese ministries keep a measured tone, the shift to boosting domestic consumption is accelerating. Then there is Spain, stepping onto the stage as a wild card. Under pressure from an expanding trade deficit, Madrid grows bolder in courting China as a strategic partner. Spanish officials highlight the fact that 25% of their goods from China are crucial intermediate products. Tariffs on these items risk crippling homegrown industries. Spanish industry leader Javier Torra Mira recently warned that small and medium-sized enterprises will not survive if the United States continues to ratchet up tariffs on European markets. In April, Prime Minister Sanchez made his third trip to Beijing in 3 years, cementing deals that could reduce Madrid's reliance on the U.S. European Union partners watch closely. Will they follow Spain's pivot or remain cautious, wary of angering Washington? As U.S. officials lash out, branding any Chinese partnership as cutting their own throat, many in Europe wonder if it is time to break free from decades of American-led trade policy. With each new tariff or capital restriction, the ranks of skeptics grow. Could the EU ultimately decide that forging closer ties with China is more beneficial than clinging to an unpredictable ally across the Atlantic? The fallout from this trade war extends far beyond the corridors of Washington or the offices in Beijing. Supply chains that once stretched seamlessly around the globe are warping under high tariffs. The United States decided to slap duties not just on Chinese goods, but on imports from allies as well. By imposing levies of up to 20% on the European Union and well over 100% on certain Chinese products, Washington aims to reshore manufacturing. But the unintended effect is higher costs, production bottlenecks, and intensifying inflationary pressures. Spain's predicament illustrates the knock-on effects. 20% tariffs on its exports to the U.S. put Spanish small businesses in peril. Meanwhile, China's strategy, lowering average tariffs on non-U.S. partners from 8% to 6.5%, tempts European firms to shift more of their supply chains toward Asia. As Beijing invests heavily in Spanish electric vehicle ventures, a new trade order could be emerging. The once stalwart reliance on transatlantic ties is fraying. Financial markets amplify these disruptions, as investors worry about broader decoupling. Talk of the United States restricting Chinese businesses from American capital markets and Holy Grail pension funds signals a new phase of economic warfare. If China dumps its massive holdings of treasuries, the repercussions could reach every pensioner, homeowner, and business reliant on stable bond yields. A flight from the dollar might not happen overnight, but each escalatory step nudges the world closer to a system where global capital bypasses Wall Street in favor of alternatives. All eyes now turn to inflation, jobs, and potential stagflation. JP Morgan's dire forecast for a 2025 recession still looms. with unemployment projected above 5% and inflation near 4%, workers could face the worst of both worlds, shrinking paychecks and rising prices. Could this be the tipping point for a global financial crisis? If yields keep inching upward, bond prices may collapse altogether. And if that happens, will American leadership crumble under the weight of a broken financial system? For the moment, tensions show no sign of cooling. Washington's 90-day reprieve left many questions unanswered. The tariffs on more than $550 billion in Chinese goods remain in force, providing little clarity or relief for manufacturers who plan sourcing months or years in advance. Rumors suggest an even harsher round of sanctions may follow if Beijing does not capitulate on industrial subsidies. Secretary Besson's vow to produce a blacklist for American investors raises the specter of outright financial decoupling. China's response appears measured yet resolute. Officials quietly deepen ties with Europe, especially countries like Spain that crave investment and worry about U.S. unpredictability. As top Chinese fund managers turn to new markets, the greenback's long-held status as the default currency could weaken. Regardless of short-term negotiations, the broader trajectory is a world splitting into blocks, one anchored by the US dollar and the other crafted by China's capital. Meanwhile, Spain's leadership tries to navigate these treacherous waters. With the country relying heavily on Chinese imports, and with Beijing bankrolling Spain's electric vehicle sector, Madrid grows skeptical of an American alliance that appears increasingly combative. Will the European Union follow suit, or will internal divisions slow any decisive shift? Observers say a Sino-centric trade bloc may quietly take shape under the dust cloud of tariff threats. If so, the United States might wake up one morning to realize the global economy has moved on. Right now, investors brace themselves for another unpredictable quarter, hoping a bond market collapse does not materialize. Yet, from Madrid to Beijing to Washington, the writing on the wall is clear. This conflict has become a battle of wills and survival strategies with no easy exit in sight. Even if a sudden compromise arrives, the deeper realignment may already be unfolding. Spain's pivot, China's debt leverage, and the White House's volatile policies all point to a future in flux. Will the U.S. lose its global economic leadership? Or does it still have time to mend alliances and stabilize markets before another tariff wave strikes? Here, in early spring 2025, nothing is certain, except that the stakes are rising each day. As the world holds its breath, one final question lingers. Is this trade war just the prelude to something far greater?